All right, thank you everybody for joining us today. My name is Wesley Boudreaux, one of the ExxonMobil focused advisors here at the Retirement Group. What we're going to do today is a little bit different. We're going to go through a lot of different questions we've been getting over the last couple months, whether it be questions that we've gotten after the webinars, questions that have been emailed to us, or questions that myself and other advisors have gotten from prospects and clients. So there's a Q&A box on the screen, but we're not going to be using that today since we'll go through some of these questions. There's also still going to be that chat box on the screen, so do keep an eye on there. We will put some information in there, like how to follow us on LinkedIn to get the ExxonMobil specific information from us, how to sign up for future webinars or any question you may have there, and then also how to possibly schedule an appointment with myself or one of the other ExxonMobil focused advisors. Now, before I get started, just another quick reminder: even though we've worked extensively with ExxonMobil employees, helping them transition into retirement, that does not mean we're endorsed by ExxonMobil or employed by them. But should you have any questions, whether it be the pension, the 401k, healthcare, retiree, medical, life insurance, any benefits, if you would, or financial planning questions, just reach out and give us a call at 800-900-5867. So for those of you who do not know who the Retirement Group is, again, we are an independent financial advisory firm that focuses on working with corporate employees and helping them transition into retirement. We've been doing this for a little bit over 30 years, and for a large chunk of that, we've been working with ExxonMobil employees. Now, the reason we focus on only a few different companies, it allows our advisors to have a deeper understanding of your benefits inside and out. So again, like I said, whether it be digging into the pension plan, the 401k, retiree medical, life insurance, all the different benefits you get from ExxonMobil, we can probably run through and help you out with some questions there. But also the biggest thing is for us to kind of help you in that transition process so that we make sure you maximize those benefits once you depart services from ExxonMobil. And whether it be looking at retirement in one specific year versus another versus a quarter, we'll get into how interest rates can play into that in just a moment. But it's really important to know all this, whether you're a couple of days away from retirement or 10 years from retirement. It works both ways. Now, we do have offices throughout the country, so rest assured if you need to sit down with somebody face-to-face, we can probably accommodate that. But obviously, this day and age, we do a lot of web meetings. I've got clients all over America at this point now. Whether you want to do emails, phone calls, whatever's most convenient for you. Obviously, with ExxonMobil being a global company, we work with a lot of individuals overseas as well. Now, the best thing you can take us up on, if you have not done one already, or it's been over a year or two since you've done it, is our complimentary cash flow analysis. This is really a detailed financial plan specific to your situation and also the ExxonMobil benefits to help you determine the best day to retire so you can maximize those. You might come to me and say, hey, Wesley, I'm thinking about retiring at 62 because that's what I always thought. Or I'm not going to retire until my son graduates college, or I hit some other milestone, whatever it may be. I hit 40 years of employment. Those are all good in theory, but in reality, the key thing to look at is when's the best time to retire financially. And sometimes it may be that you need to work a little bit longer. Or maybe if you go earlier, you might maximize your pension based upon interest rate calculations or something like that. But give us a little bit of time, spend about 10 to 15 minutes with us gathering data, and then give us about a week to put that detailed plan together for you. And we'll set some time to go over that. But we can look at variations, whether you have a specific desired retirement date, whether we want to look at whether you need to work longer, work shorter. We can go through all those different options and look at weighing the options of the pension, whether you want to take the lump sum or annuity or combination. How do you want to tackle the 401k? All those go into play with that cash flow analysis. And again, that's something that's complementary, and at least it gives you a good idea of where you stand in the transition process. Before I get started with some of these questions, let's give you a quick interest rate update. This one's pretty timely because we just got the March rates were released last week. So we do have those updates for you. And unfortunately, it's not going the direction we were hoping. We were seeing the interest rates coming down a bit, and we were hoping for that to continue. However, what happened was the interest rates kind of skyrocketed last year in 2022, and we saw them climb all the way through October, and they started declining November, December, January, and we were hoping that trend was going to continue, but they started kicking back up in February and March. Not as high as they were back in October, but they have come up a bit, so that trend has reversed, and we didn't get as much of a drop as we were hoping for Q3. So what do these interest rates mean to you? You take a look at that seesaw up there on the top of the screen, and what happens is you've got the ExxonMobil pension plan, which is a classic defined benefit plan that runs a formula looking at your years of service, your final average pay, and a multiplier and a Social Security offset to determine how much they're going to give you as a single life annuity for the rest of your life. From there, you can deviate. You can say, I don't want a single life annuity. I want to make sure my spouse is covered, so I want to do a joint survivor. Maybe I want a period certain, so it's paid out over a certain period of time. Or in this case, maybe you want a lump sum. Maybe you want to take that cash, reinvest it yourself, or work with a retirement group or another firm to help beat that annuity payment they would give you, or because you want more flexibility in choices, or flexibility in passing to your beneficiaries besides just your spouse possibly. There's a lot of reasons for this. We can go through those one-on-one with you. But what they do is they look at interest rates to determine what that lump sum value is going to be. So if we look at that seesaw, when interest rates are low, which they were during the pandemic, you're going to see some of the higher lump sums. When interest rates actually go up, it's going to drive down those lump sums, and that's what we've been seeing over the last year post-pandemic. So think about like a pendulum. The interest rates went pretty artificially low during the pandemic to help fuel the economy, which drove up some high lump sums. Now we're on the other side of that, where the pendulum swinging to increase interest rates and decrease those lump sums. So hopefully we'll see this kind of settle off here soon and come back down and get to long-term rates, and you'll see a bump back up in your lump sums. But what they do is they look at how old are you, look at what longevity tables look like to figure out what your how many more years they're on the hook for potentially to pay you. Look at the current interest rates and do a net present value calculation to give you that lump sum for you to go out there and try and recreate that annuity or beat it if you can. So if we look at those interest rates, what happens is ExxonMobil does them on a quarterly basis, and they look back at the average of the third and fourth prior month. So that's why we just got the March month out. So that gave us enough to calculate out what the third quarter is going to be for 2023. And then if you're grandfathered, you get a different rate. That's the grandfather rate, which is a GAT rate, which follows the 30-year Treasury at 95%, and it looks at an average of that, and that's a little bit lower. So let me zoom on these so you have an idea of what they look like. But for commencement of benefits in the third quarter, we're looking at 5%, 5.16%, and 5.06% for the segments. That's the first, second, and third segment. And then for a grandfathered employee, it's going to be 3.5%. So again, a lower rate, which equals a higher lump sum. If you're not grandfathered, again, those pension rates or the Pension Protection Act rates are used, first, second, and third segment. That first segment is going to be for the first 5 years of retirement, second segment, years 6 through 20, and the third segment, years 21 and beyond. So for most of us, that second segment has the highest weighting because it covers 15 years of retirement. If you take a look at the history kind of there below, we saw that for the first quarter, or actually if you go back, we put on here last year as well, you can see that climb in interest rates over that time period. And then it actually kind of, for right now, for second quarter that we're getting into, if you look at that second segment, for example, it's capped out at 5.38%, and then we've come down a little bit to 5.16% on the first segment. We're still going up a bit, so we're kind of essentially leveling off here at this point. We'll see what fourth quarter brings. But if you're thinking about commencing your benefits here in the second or third quarter, it's important to run a review. There may be nuances and changes to those, but generally speaking, about a 1% change in interest rates equals about a 10 to a 12% change in your overall lump sum. So right now we're not seeing a big change, but if we see interest rates come down, it could be beneficial fourth quarter or into first quarter next year. So just give us a call. We'll be happy to kind of run these for you and show you what it looks like for your specific situation. So spend a lot of time with that because a lot of people want that information, but let's get into some of these questions. It looks like we've got 7 different questions that they compiled for us to kind of go over today. So first question, I keep hearing about a grandfather pension. How can I find out if I'm grandfathered or not? Okay, so I just showed that breakdown of the grandfathered, and you want to be grandfathered, but you got no control over that at this point. But being grandfathered gives you that GAT rate, which is a lower interest rate, which in turn calculates out a higher lump sum. We just mentioned it was 3.5% for third quarter, coming down from 3.75% here in the second quarter. And then the non-grandfather was around 5%, for most of those segments. So that's about a 1.5% difference, which is about a 15% difference or so in lump sums from a grandfather to non-grandfather employee. The way you'll tell that is if you go in there and do a calculated estimate. It goes in there, it'll show you the interest rates, and you'll see if it's that single interest rate or if it's those PPA segment rates. Another quick rule of thumb to calculate, they did this based upon the introduction of the segment rates, but if you go back, it's based upon your age and years of service at that time. So if you fast forward right now, if you're somebody who is 65 or older and had 25 years of service or more by the end of last year, so the end of 2022. So again, by the end of 2022, if you're at least 65 with 25 years or more of service, you're going to be grandfathered. Now, unless you have like a a leave of absence or a bridge or something there may be an issue there. But if you have a question on that, we can walk you through how to estimate your pension and show you. At the end of the day, it is what it is. You're not going to really be able to change it, but it's still, at least it's good to know. Question 2. I'm thinking about retiring in the next few months. When do I have to elect and submit my pension forms? Okay, so the answer from Exxon is going to be, usually about 90 days out is what they want from you in order to put those forms in, so it gives them enough time to get the paperwork done and get your check out to you, whether it's going to be an annuity payment starting or whether it's going to be a lump sum rollover check that you're taking. But in reality, you can actually go up to the last minute if you want to. It's just it's going to delay your paperwork and your processing. So let's assume maybe someone's going to retire in June and they dragged their feet and didn't submit their paperwork until May or something like that. Then it's not going to change as far as their commencement and their options there. It's just going to be that instead of getting a check early July, it may not be till August or September that you get that. So it delays that processing. Now, in some cases, if you've had a quadro or something like that, which is a divorce, it could extend things even longer. So you need to get some of that done and get those manual calculations done as soon as possible. Those can stretch out 6 to 9 months in some cases, I've seen. So again, be very careful about that. But the sooner you can get in, the better. And keep in mind, there's a difference of your retirement date and commencing your benefits, in which case you can actually retire and then defer your benefits later if you want to do that as well. And give us a call, we can go through those reasons. Question 3, I'm only getting 80% of my pension. How do I make sure I get 100% of my pension? So this might kind of go into what I just mentioned about deferral. So if you retire from ExxonMobil, and the thing I want you to keep in the back of your mind is you want to retire as a retiree, not a terminee. So to become a retiree, you need to be there. You need to be age 55 plus 15 years of service. So keep that in the back of your mind. The difference is, as a terminee, you may not have that lump sum option. There's been some changes the last couple of years, but generally speaking, according to the plan, you don't have a lump sum option. Plus, you're going to have a much further reduced benefit. But if you retire as a retiree, at 55 plus 15, you get 100% of your pension at age 60. If you decide to retire or commence your benefits earlier, there's a 5% reduction each year. It's actually a daily reduction, but just to say 5% each year. So if somebody's telling me that I'm getting 80%, then they're probably 56 years old and a retiree. So again, a 5% reduction each year. So for 4 years, that's a 20% reduction. So this person, in this case, they could retire at 56 and go ahead and collect their pension, and they're going to get 80% of what that total pension would be. Or they can retire at 56 and defer their pension another year, 2, 3, or 4. You don't want to go past 4 because 60 is a sweet spot there. But even if they were taking the annuity, their annuity would essentially go up by 5% each year because they're aging out of that 5% per year age penalty. If they're taking the lump sum, they've got a combination of the age penalties that are changing and also interest rates. It could be good or it could be bad. So if somebody's looking to watch interest rates go down, if they think they're going to go down, you could get a 5% bump because of the age penalty by waiting, and you could also possibly get a bump by interest rates changing. If interest rates went up, it could wash out that 5% bump on the age penalty. So again, if you've got questions on this, give us a call. We can run through the cash flow analysis and show you the benefit of potentially deferring as well to get out of those age penalties. Question 4, can I take a partial lump sum and a partial annuity? This is actually a pretty unique feature about the ExxonMobil plan, which we worked with a lot of plans and don't see this elsewhere, but it was back, I think, 2015 they made that change where it used to be an all or nothing, where you either had to take the lump sum or take the annuity. But then they changed it so you could break that up in 25% increments. So you could take 25% lump sum and 75% annuity, 50-50, or maybe take 75% lump sum and 25% annuity, which is a great feature because a lot of times you didn't need the entire annuity, or you didn't want to tie up all your eggs in one basket, for instance, or you didn't want to take too much risk with that lump sum. So we may run the numbers and show you, okay, here's a 100% annuity versus 100% lump sum versus 50-50, 25-75. However you want to look at that, we can show you. But a lot of times when you run the numbers, you want to make sure you got some essential, you want to make sure you got some guaranteed income covering your essential expenses, whether Social Security covers all that, or maybe you want to add a 25% annuity from ExxonMobil. Or maybe you want to look at taking a lump sum and buying your own annuity for more flexibility. We can look at all those different options for you. But again, these change based on interest rates, so it's important to look at that at the appropriate time. So again, yes, you can take a partial, and it's important to review those options. Another one here. I'd like to make investments outside of the ExxonMobil 401k plan. Can I move 401k money outside of ExxonMobil? Yes and no. For as good as the ExxonMobil plan is, as far as the lowest cost we've ever seen, Unfortunately, it's a little bit limited as far as accessibility. You don't have that many investment choices in there, and it's also hard to get that money out as well. A lot of companies give you like an age 59 withdrawal where you can take a withdrawal or a rollover from your 401k and roll it to an IRA where, yes, you get more investment choices. Unless you came from another company and rolled money into there, if you've always been ExxonMobil, really the only way you're getting money out prior to being a retiree or a terminee is going to be if you had after-tax money that you put in there. So instead of maybe putting pre-tax, or maybe you hit your pre-tax limits and start putting after-tax money in there, then yes, you can get access to that. But there are some nuances to how you access that because it's on a proportionate basis. So let's say maybe you've over time you've been putting money in over the years, and you've been putting some after-tax money in there, and maybe it's $50,000 you put in. But let's say that maybe it's grown to $100,000. So what would happen is you could take out up to that $50,000, but if you're taking it out, want to do a rollover and or something of that nature, half of that $50,000 would be tax free because your cost base. The other half would be taxable as your earnings. So what you would do is you could actually take the cost basis to yourself if you want to, or roll it to a Roth IRA, which is our recommendation because it's going to grow tax free. But the earnings would want to go over to a rollover IRA. So again, it continues to stay tax deferred. You're not paying taxes on it just yet. And then once you do that, you could potentially do it the next year, but then that percentage breakdown changes proportionally year by year. So it does get complicated. So if you have questions on it, give me a call. I'll be happy to run through that with you and let you know where you stand there. But again, that is a way to actually maximize Roth contributions by doing after-tax contributions to the ExxonMobil 401k plan and rolling over to a Roth IRA. Another question here. I heard there are some tax laws that allow me to reduce the taxes on my ExxonMobil stock and my 401k. How do I take advantage of those laws? Okay, so this is probably referring to NUA, which is net unrealized appreciation, and that's an ability to actually pay ordinary income taxes on the cost basis of your ExxonMobil stock, and then the growth, you don't pay taxes until you physically sell that down the road, whether it be a day away or 10 years down the road. And when you do that, you pay long-term capital gains taxes on the growth of that. So a lot of this kind of went out the window a couple years ago when the price dropped, but now obviously, hopefully, if a lot of you were able to pick up some stock, in the 30s, 40s, and 50s, you definitely have some NUA exposure there if you haven't sold it. And the great thing about ExxonMobil and the 401k plan through Voya is they keep track of your cost basis share by share. A lot of other companies just do an average, so as the stock changes, those averages change. But for ExxonMobil, we can take a look at your statement on that, fourth page usually is where it is, and go through there and run a spreadsheet to show you, okay, if I want to exercise NUA on all my shares that were $35 and under or $40 and under, we can go through all those different analysis on all those to let you know the best option. But at the end of the day, what happens is NUA's got a lot of different triggering events. You have to, separate service before you can exercise it. There's also the age 59.5 has a triggering event as well. If you've taken a withdrawal post one of those triggering events and you didn't exercise NUA, you can't do it anymore. It's an all or nothing transaction. Once you do it, you have to roll over the rest of the money. But a quick example, let's assume maybe you got $100,000 worth of Exxon stock in there, and maybe you got a cost basis of $25,000, meaning between you and company match, you put in $25,000, it's grown by $75,000 to $100,000. So if you never knew what NUA was and you just took withdrawals from the 401k or rolled over to an IRA, you're going to pay taxes 100% on that $100,000 whenever it comes out. With NUA, what would happen is you exercise it, you pay taxes on the cost basis the year you exercise it. So you pay tax on that $25,000 cost basis. That growth of that $75,000, you don't pay ordinary income on it. You pay long-term capital gains when you sell that. So whether you turn around and sell it a couple weeks later or whether you hold on to it for years to come, you're not going to pay ordinary income. You're going to pay long-term capital gains, which is either 0, 15, or 20%, depending upon your capital gains tax bracket. And there's ways we work with folks to get them down to that 15 and possibly the 0% to save you quite a bit in taxes, depending upon how much you have. Now, it's important to run this through us because, again, if you make a mistake, it can be costly. And there's a tax savings on there, but you also have to focus on the volatility and fluctuation of ExxonMobil stock as well to see if it's actually worth it. So I don't want to spend a lot of time on there, but just give us a call. We can get us a copy of the statement. We can run through there and tell you if you have NUA potential or not. What do we say? 7 questions. So last one here, question 7. I've just been offered a supplemental savings plan. What is a supplemental savings plan? Okay. Well, congratulations. If you've got the supplemental savings plan, the chances are you're a high compensated employee. So this is a plan that ExxonMobil has for the 401k if you hit the limits as far as your contributions and they're matching, and so they're no longer able to match for you. It could be based upon what you're putting in there, or it could be based upon your pay structure. If you're maxing the 401k limits, which is $66,000 for somebody under 50, as far as total contributions between you, the company, and everything. So if you have excess company match, it will go into the supplemental savings plan. Now, this is a non-qualified plan. So what I mean by that is it's deferred, but it's not tax deferred in the sense that you can roll it over to an IRA. Once you separate service, you have to actually get that paid out to you as a lump sum. So what they do is they put in the excess contribution that otherwise couldn't go into the 401k plan into this. It's not your contributions, it's company match contributions, and then they apply an interest rate credit to it each year, so it does grow a bit each year. But it's non-qualified. It's subject to their ExxonMobil paying it, so it's not protected under ERISA guidelines or anything like that. But fast forward, let's assume maybe you built up a supplemental savings plan that's worth, let's say, $70,000, and you retire. You have to get that paid out pretty quickly, and that's going to be a lump sum payment. So we work with a lot of individuals as far as juggling that. When's the best time to retire? You may not want to necessarily retire in October or November, so you've gotten close to full years of income, and then all of a sudden you get a supplemental lump sum on top of that, because it could kick you into a higher tax bracket. And then it goes further. A lot of times people that are in the supplemental savings plan may have some of these supplemental pension plans as well, or non-qualified pension plans. So give us a call to talk through that, because there's a lot of different tax planning strategies you need to focus on, because otherwise, if when you leave ExxonMobil, if you're highly compensated, you might have a pretty heavy tax bill that year you retire, or the next year, depending upon when you retire in the year. So again, just give us a call to kind of talk through this, because that's very important. So again, those are some of the questions we've been getting, and obviously if you have any additional questions, go ahead and give us a call. But to kind of summarize it, one of the best ways to kind of tie all this together is to run a cash flow analysis. I think I talked about that at the very beginning. Give us a couple minutes to kind of gather the data for you. It gives about a week to put together, and we'll run through that, let you know the different scenarios where you stand, what your retirement picture looks like, and the pros and cons to different dates as well. And obviously, just give us a call to schedule a meeting with myself or one of the other ExxonMobil focused advisors. That plan I mentioned before, a quick little note here, about 3/4 of Americans over 50 don't have a written plan. Like I said, spend about 10-15 minutes with us. We'll do the grunt work for you, put it together, and then we'll spend some time reviewing that together to let you know exactly where you stand and to help you determine the best method to maximize all those ExxonMobil benefits for you. And so again, I'll leave this up here for a second. A couple QR codes if you need to schedule an appointment with myself or one of the other Exxon advisors. It'll get you into our calendar to set something up about a week out. Those calendars don't give you access to the next week, so if you have something more urgent, give us a call. There's also a QR code for our LinkedIn page. You can follow us specifically for the ExxonMobil LinkedIn page we have, so you stay up to date on future webinars, different interest rate updates, changes, things like that to the plans. And then always, you can reach that info@theretirementgroup.com, or simply give us a call at 1-800-900-5867. And again, I want to thank everybody for joining us to go through some of these questions. If you have your own questions, just reach out to us. But again, a quick reminder, we've worked extensively with ExxonMobil employees. However, that does not mean we're employed by ExxonMobil or endorsed by them. But should you have any questions on any of these benefits, just simply give us a call, 1-800-900-5867. Thank you very much. We hope you have a great day.